What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Today is going to be a live reaction to the FOMC press conference. So, if you guys are members of the Telegram, I did a live drop or release reaction, and so the FOMC decided to hold rates steady again, and I went through a long 20-minute talk about the important parts of the release. Let me I'm going to mute this other. Oh, never mind. Let me share the screen because he's going right now. He's going up there. And I'm going to share my screen with Telegram. All right, we're going. So the big thing is that rates were held steady. Let's see if I can go here. Where am I at? So he's not on the podium, so I'm going to go here. I thought the big kind of wow sentence was the very first one. Recent indicators suggest that growth of economic activity has slowed from its strong pace in the third quarter. This is admitting that they see some slow growth slowing. And is he coming up to the podium now? Let's see. Yes.
Employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. So
this is just boilerplate. He didn't say much there about inflation. Remember, yesterday we had CPI come in 0.1%. That's annualized 1.2%. Last 2 months, if you annualize that, it's 0.6%. If you analyze the last 3 months, it comes out to 2.1%. December, it looks to be low as well. So overall, where is he getting this inflation? You have to go to year over year. You have to start looking at core and some of these other kind of sticky things. Also, if you take out shelter from CPI, we're already at negative 0.5%. And shelter is a very controversial topic. It's a very controversial component because with shelter, it's measured differently in CPI and PCE. It not only has different weights, but the survey methods are different and how they count everything. So even within the single government, they have two different measures for shelter component. Okay. It's a controversial topic. And that's not even to mention all the different ways that it is counted around the world. But so if you take shelter out, because it's a lagging indicator and it will come down, it will follow everything else. We're at 0.5%, a negative 0.5%. So inflation is coming down, but he hasn't quite said that. Let's see if he says anything about growth.
early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest.
So I talked a lot about that on the live stream that I just got through on Telegram. And so he's talking there about the cumulative nature of their policy. And let me share this other screen. So the cumulative nature right here in the statement, cumulative tightening of monetary policy. There is a lot in that solitary sentence, because they're saying that they're not looking at the individual month. What's going on with the economy right now? What is our decision going to be right now? They're looking at what they have done compared to what they have done and what the economy has done over a broad narrative, a broad time span, because they're building a narrative. They can't very well build a narrative in one stinking month, right? They could by putting out some financial press headlines by all of the Fed governors, which is what they do anyway all the time. They put that out to build this narrative to nudge and tweak the expectations of the market, okay? But the cumulative tightening, they want to broaden that narrative out to be the whole cycle, and they want to control the framing of the entire cycle. Okay, that is actually their monetary policy. Is this broad framing narrative? That is their monetary policy. Now, I also talked about this part, the lags. I don't believe in lags. I mean, I believe in some tiny, maybe form of lags. But what's going on with the economy right now has been predicted. I've been predicting it very well. If you understand what's going on and what the nature of our system is, you can predict with high accuracy the trajectory of the market. The reason why they have to invent mythical lags is because it doesn't fit into their broad cumulative tightening narrative. Why doesn't the market react right away? Well, I can tell you why, because your policy really doesn't do anything. It's not mechanical at all. The reason why there's lags is because it takes time to form this narrative and try to influence the market. You make a narrative that fits in generally with what's going on. The Fed will follow. They influence around the margins. But the broad sweep of the way the market is headed, that's the way it's going to head. And I said in the previous live stream that I do believe in lags, like, okay, prices go up, but the economy can't sustain it, so prices have to fall. That's a lag going up and then coming down. But it's an order of events that has to happen. And that order of events can sometimes go a little slower, sometimes a little faster, right? So there are some unknowns, but these lags are mythical. Nobody can tell you what the lag is going to be. And I know very smart people like Macro Alf, Jeff Schneider, those types of people, they believe in these lags, and they'll say, oh, the lags are like anywhere between 12 and 18 months or 9 and 24 months. They just cover all this time. But these lags don't exist in reality. It's just because you're behind the 8 ball. Okay. Nobody can describe exactly what the lags are, how they work, and what's the time frame, because they don't exist. It's kind of like in cosmology or whatever, where you have matter, and dark energy. Even though we never seen dark energy or seen dark matter or anything, we don't even know they exist. But the reason why they created that was because there was a hole in their theory around galaxy rotation speeds. So there's this hole, and they filled it with something mythical, and they called it dark matter. That's exactly what they're doing here. There's a hole in their understanding of the market, and that doesn't match their narrative quite. And so they pop in this lags that nobody can describe. So lags don't exist. Okay. Let's get back to Jay Powell.
Interest rate unchanged, and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track.
Remember, that was what I said was the important sentence, and why markets, I think, reacted initially like they did, because the very first sentence says the economy has slowed substantially. I mean, that is about, well, it's bearish on the economy, but it's dovish, relatively dovish on monetary policy going forward. So what I said in the earlier live stream was that you could see kind of this broader sweep of where they have to build into their narrative a pivot. Maybe it's going to happen. It didn't happen this time. This was the last chance that they had to raise rates according to some of their prior projections. And January, maybe March, the market now is pricing in a cut by March, perhaps 2 cuts. So that is, they have to build up to that. You know, they don't want to just like have an emergency meeting. They didn't have to necessarily do that with COVID, even though they did have some cuts in 2019, but they could cut 1-2 percentage points for COVID because it was, people would believe that it's an unseen thing, right? But this time, minus any calamity, I mean, maybe there's going to be a cyber attack. Who knows? That's what a lot of people are floating out, that's going to be the next thing. Then they could cut drastically. But they're trying to build this narrative and move it out. So first, acknowledge that there's a recession coming, which is what they are doing right here. Then January, maybe make some more dovish comments and then cut in March. But okay, let's keep going.
Back to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgages. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year.
Okay,
the labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged, with the median projection falling to 1.
Okay, change in real GDP. I mean, this is going to be wrong, obviously, because we're going into recession, so there's nothing below 0. But 2024 will likely be below 0. Even the error bars here are showing not below 0 is not even a possibility. All right. And they are showing this one. Let's see, 2023 is pretty tight because they know pretty much what it's going to be at this point. I think it's going to be lower. I think it might be 0 or negative for 2024. But of course, all of their projections always go back to 2% for GDP, inflation. And the reason for that is because, guys, if you're new to my content, in a credit-based system, at the end of a credit bubble like this, inflation equals growth. Inflation equals growth. And you can go back and look at from the great financial crisis to today, they match very, very closely. And by inflation, I mean actual money printing, growth of credit. The growth of credit, because what do you do to create growth in the economy? Well, you take out a loan. You know, and in aggregate, the aggregate amount of credit creation is going to equal roughly the growth rate. That's why you see GDP and inflation projections are the same. They're going to watch. We'll see in a couple minutes here. The inflation projections are going to be 2%.
1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the consumer, inflation has eased over.
Okay, I'm going back to this chart. Unemployment rate. Okay. Nothing fancy here. They're expected to be around 4 for a long time. Of course, this also does not show any sort of recession, because in a recession, we'll see a spike in unemployment. And you would see that not as average maybe for that year, but you would see the average increase quite a lot, as well as the error bars and stuff. But they're not showing any recession. So their base case, according to these first two charts here, their base case is no landing. No landing. And I talked about that on the Telegram live stream just a few minutes ago, was that Powell, that's a way that he can start building a narrative towards a pivot, or a rate cut. I think it's already been a pivot, but he can build that by lost my train of thought. Oh, they've acknowledged the recession kind of in the economic slowdown line in their FOMC statement, but it's not showing up here in these numbers. Now, the next time these come out, which I think will be the March meeting, they can show more, right? So they have a different amount of tools here that can create this overarching cumulative monetary policy tightening narrative, or monetary policy narrative. The summary of economic projections, which these charts are, that is part of that. Okay.
To 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of...
All right, here you go. So future projections right to that 2%, just like GDP. And they're pretty darn confident. Their error bars get less as they go out to 2026 and stuff. This is not going to happen.
Getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026.
Look, there's absolutely no overshooting of the 2% target. Remember, they have a 2% symmetric target. So if it's under 2%, they are supposed to ease. If it's over 2%, they're supposed to tighten. And I mean, this is just such a fairy tale, man. You're telling me that all these economists at the Fed, even with the error bars, all of these economists show a very nice no landing down to 2% for GDP and for inflation. I just find that extremely hard to accept.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly likely to be appropriate.
Skip forward to some of these charts, because the rest of it's probably just going to be boilerplate. And here we have the dot plot. Nobody is showing a rate hike anymore. See that? So this is the current level because this was the last meeting. There's two members that think that it's going to stay at this level through 2024. Are you kidding me? Like that, these people are actual members of the FOMC. And they think that their policy is going to stay the same through next year and one into 2025. Oh my God. I don't know how much these, Fed presidents get, or these governors, how much they make. But you have to be silly, like not even serious, should not even be taken serious in economic circles. If you are projecting out to 2025 that you're going to keep the policy rate the same, maybe this is a mistake. Maybe he didn't finish his homework and he didn't even move the dot until 26 or something. But this is just complete garbage. And notice here, even the biggest brains show no possibility of a dramatic cut. I think it's crazy.
To raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data.
Okay, now we're getting into the Q&A. We'll watch a few of these, not all of them, but I think it's funny how they like raise their hand and they obviously know the front row goes first, but they raise their hand. I don't know. It's like theater right here.
I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy.
Of course, these are planted questions, a lot of them. I would say in the front row, 90% of them are planted. And they thought there was going to be some, because, everyone's parsing the FOMC statement word for word, seeing if there's anything different, trading their algos based on, what's in there. And so they thought, oh, people are going to be looking at the word any. So we need to ask a question about that.
Policy firming that may be appropriate. So any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC.
Oh, sorry, Mike. Yeah, okay.
Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed.
So just to clear up that, so as inflate, because, the real rates would be the policy rate, 5.25, bottom of the range, 5.25, minus the inflation rate, 3.1. And as that inflation rate goes down, that actually means that the real rates are going up. That difference. So that's the question is, and I guess who did they say? Waller asked or said that they might cut because that could, if rates continue to fall, which that's what I've been saying for so long. It's not on. I haven't said it from the angle that it's going to make real rates rise, but it's just going to look bad. It's going to look stupid for the Fed to keep their policy rate at 5.25 and the 10 years at 3, but that's what he's asking here.
Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this:
they're doing more than that. They're doing more than thinking and talking about it. The largest, most liquid market in the world, the U.S. Treasury market, is pricing it in. Okay? They're pricing in a cut by March now, or a cut in March at the March meeting. So they're doing more. They're putting their money where their mouth is, actually. A lot more than these overpaid Fed presidents and stuff. Where one of them thinks that the rates are going to stay the same out to 2025. Good Lord.
Seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not, that's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was, and there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing, and a preliminary kind of a discussion like that. Not everybody did that, but many people did, and I would say there's general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
Okay. Remember, I said all their SEP charts there did not have recession. So they are forecasting right now no landing. That's the narrative they're trying to push out, is that everything is going smoothly, everything is acting appropriately. We don't care if bank credit is tanking, contracting actually. We don't care if M2 is contracting for the first time in 40 years. We don't care if CPI is coming down and if less shelter, it's negative 0.5%. We don't care if global trade is falling. We don't care. We don't care about us. None of that matters. No recession.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early.
Okay, let's see what he said there, because I wanted to point something out.
So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without.
Because the situation was so weird. Let me get that one more time.
I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and
inflation to come down without the job losses. He did not mention their policy. Due to circumstances, he believed that the economy could cool off and not cause a recession or job losses. Nowhere did he mention his policy, because I truly think that he knows that the Fed doesn't do anything. They are a narrative management, broad, cumulative monetary policy narrative. That is their weapon. So anyway, I just
tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
Unexpected. To whom is this unexpected? To you, the 1,000 PhD economists at the Federal Reserve? Because it's not unexpected to the market. They're saying that you're going to cut in March. There's a possibility of 50 basis points in March. And it's a decent possibility. Let me go share this, refresh this. Okay. January, there's already 8% chance of a cut. March, there's a 60% chance of a cut, and this actually changed since we were looking at it earlier. But there's a 5% chance of a 50 basis point cut. So to whom is this unexpected? Is a recession unexpected? There were a reason for you to cut. Not the market.
I'm curious, if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, 2000.
Oh my gosh, yes, they were. The most anticipated recession ever didn't occur in 2023. And if you guys were listening to my stuff, you were well prepared for that eventuality. I had a 25% chance of no recession, 50% chance of a mild recession, and a 25% chance of a hard recession. And that went pretty much the entire year until, once we got through, I want to say maybe July or August, and it started looking like Q3 was going to be okay. it got less and less likely, obviously, that we were going to have a recession by the end of the year or officially go into recession. So, yeah, this was the most anticipated recession ever. And most people, most macro analysts or forecasters got it completely wrong.
2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus or a little more than that growth year at a time when potential growth this year might even have been higher than that just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Everybody, even the third row, is raising their hand. Don't they know? We need to get the planted questions in first.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, the rate of inflation that you're expecting, as opposed to supporting the economy?
Let me try to answer that. Powell is going to say, we are searching for the neutral rate. We're searching for the neutral rate. And this goes into with the lags and everything. That's just myth. It's just a myth, just like our star for unemployment stuff. That's a myth. These are all just variables that are used to complete an equation that they have, that they think is correct. And they solve for X, and X comes out to be 2.5. That's what the neutral rate is going to be, So that's how I think he's going to answer this.
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time, but it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election? Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are.
Okay, so they had to ask that question, planted question most likely, because they want that out there. They want the answer out there, that they don't look at politics. Because remember, the Fed is owned by Wall Street. They are under oversight of Congress. Powell is nominated. I think all of the officers in the Fed are nominated by the president and then voted on by the Senate. So there is oversight there. But Powell is a handpicked. These candidates are handpicked by Wall Street. So Powell is playing with Wall Street, on Wall Street's team. And Yellen now used to be on Wall Street's team. Now she is full blown in on the globalist team. She was all along, but something changed in 2020 with the pandemic. I think Wall Street said, whoa, these guys are going full bore on this. This was way worse than we thought. We can't let this happen. We're fighting back. So that's why you see this big pivot with Wall Street and Powell versus the globalists. Powell is stiff-arming CBDCs and all this stuff. But anyway, back to this question. The Fed wants to get this on record, that they are not political at all. And the reason for that is because he knows the election year is coming up and they're going to go after him. They're going to go after Powell for causing the recession for political reasons or whatever the case is. So he is front running that type of criticism, saying we are not political and yada, yada, yada. Okay.
Right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take.
Feeling it confidently. That has nothing to do with quantitative. That has nothing to do with PhD economists that are out there with their formulas or whatever. Okay, that we are feeling this, and even emphasized feeling. The Fed is basing their policy off of feelings, guys.
The possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully. So as time goes forward.
Oh, and I'll also point out that that's in direct contravention to what they say. They say they're data driven. They tell you in their words exactly what they do. They follow the market. They're data driven. But now he's saying what they feel, the feelings, not data, but feelings.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
I'll also tell you about this. So yeah, let's just say that the market anticipated front ran the Fed and lifted off before the policy actually lifted off. But you see how that is part of a narrative. So the market believed a narrative for that to happen, for that even to happen. The belief the market believed us that we were going to raise, so they anticipated it. It's all based off of rhetoric and narrative. It's not based off of actual mechanical functioning of any sort of monetary policy. So if you listen closely to and read closely their statements and all that stuff, if you really concentrate on what they're saying, they admit exactly what I say, that they don't have any mechanical function here. It's all a big show. It's all a big narrative.
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along.
No, what they'll do is adjust their goals to fit reality, just like they do all the time. We will achieve our goals because they will just set them at the bar. You know what I mean?
But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making.
Tim Rose, those were wasted questions, buddy.
I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. In the SCP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we look at the total, as we make decisions about policy changes going forward, we're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%, but if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you
okay, so that's an interesting question, because, like I was saying, that inflation is growth, okay? And if you have above trend growth, or that surprises to the upside, however she worded that, you are going to have, it necessitates higher inflation. So if you have 3 or 4% growth, it necessitates 3 or 4% inflation. And so you see the pickle they're in right here. So that is a very good question. I don't know if she is wise to these ways or what, but it is. Let's just listen to what he says.
If you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
He didn't say anything there. I mean, obviously he tried to explain the process, but why would we have above trend growth if they purposefully, okay, if their policies work and they're super powerful, never fight the Fed and all this, and they had the fastest rate hiking cycle, I think, in history, or going back a long time, and they're doing all this tightening, yet we have above trend growth. So their policy didn't work. So they're going to do more, like do it harder. I don't. It's shaking the confidence here of the Fed. I mean, I don't have a lot of confidence in them. Anyway, I don't think they do much. I do like Powell. I think he's a straight shooter for the most part. He's probably the best chairman in my lifetime. So anyways, that's the last one. We're going to end it there, guys. Let me just go over to bitcoinandmarkets.com. Hold on. Okay, bitcoinandmarkets.com. That's the website. You can sign up for the free weekly newsletter, support my content there if you would like to. There's all sorts of member content, member-only content. Also, check out bmpro.substack.com. Let me bring that up as well. In the middle of writing the next post for that, probably come out early tomorrow morning. And on YouTube and Rumble, like, comment, subscribe. Appreciate that. It helps other people find the show. And let me go and see if there are any comments or questions over there in the chat. Popcorn. Fire. First like, Dex Invictus is back with us. What's going on? All right, let me check Telegram and see if there's any comments there. Dan likes a live stream. Yeah, I think you like when I react to Powell, Dan. I think you said that last time as well. Baron, yes, it will be on YouTube and Rumble. 1-year treasury below 5%. Let's do that. Let's go look real quick at the markets. So the dollar is the first one here. Not liking this at all. The reaction to this, I think it's that the verbiage right at the beginning of their statement where they said they're acknowledging slowdown in the economy. When the economy's slower, you need fewer dollars. Dollar weakens. That is totally understandable in my opinion. Now let's take a look at gold, up opposite of the dollar. Oil still under 70, just looking sick. S&P 500 is up big on the day. Let's go down to the 1 hour. Look at that. Bam. I mean, we're going to hit all-time highs, guys, on the S&P 500. It's not that far up. It was only like 2% this morning. So almost there. Okay. And let's go to Bitcoin. Check out Bitcoin. Last one before we end. 42,700. So it liked the news, not quite as much as the stock market, but yeah, you can see it did rise here over the last couple hours. We have the D-Day for the ETFs coming up January 10th. Of course, we're going to have a slower last week of the year due to the holidays, but we are getting closer, guys. We are getting closer to the ETF, not priced in. We're getting closer to the halving, not priced in. So Bitcoin is looking good in a pre-recession trade. All right. Just jumping back to Bitcoin and markets. Thanks for joining me, guys. Hope you have a good one, and I'll see you on the next one. Bye.